Welcome back to the NJCPA IssuesWatch podcast. I'm your host, Sean Steinsmith, host for everything tech related. In this episode, I'll be breaking down the headlines driving conversations in the crypto asset space. And as a bonus, this episode qualifies for Nano CPE credit. So if you're interested in earning CPE credit for this episode, pause our conversation right now and head over to njcpa.org/nano to find out how. So first things first, what exactly is this IRS code section 6050I and why have the changes to it caused so much consternation? Well, off the top, these changes, on the one hand, technically are currently in effect as we speak, because as the IRS code change is currently written, all of these changes took effect as of 12/31/2023. So technically, any of your clients that have anything to do with crypto trading or other activities are already on the hook to be in compliance with these changes. But it is not that straightforward, as we're going to find out. But overall, sort of the whole conversation here, if any of you have heard about the arguments and the online lawsuits, comment letters, or just overall conversation connected to crypto reporting for all transactions over the threshold of $10,000 for a qualifying trader business, that's what these changes are. So what exactly is going on here? Well, at the heart of the changes, right? Because IRS Code Section 6050I has always been in place, right, for cash transactions over a $10,000 threshold. But as a result of the changes, which, as they are written, are already in effect, right? So anybody, be it an entrepreneur or an individual, that receives more than $10,000 in the course of a trade or a business, and I'll come back to that later, has to do some extra reporting as of right now. But even that isn't 100% clear. And so there have been quite a few conversations and arguments online that I've been able to watch and be also part of over the last couple of years as these changes have been actually coming down the pipeline. So that's an important point to also keep in mind, that the changes outlined in our conversation here today have actually been talked about since 2021, because all of these changes were also part of the bipartisan infrastructure bill passed in the fall of 2021. So off the top, if you have any current clients that either paid or were paid over $10,000 in the course of a trade or business, and those payments happened either in cash or now in crypto, there probably is some extra compliance and some extra tax reporting that all of you are going to have to be doing. So what exactly constitutes rather a trade or business in our conversation? Well, as always, our friends at the IRS aren't 100% clear or transparent as to what actually is, but some items to work through and to talk about, right, both internally and to your external clients are, are there clients that are actually conducting trade or other crypto related activity? And if they are doing so, are they doing that as purely a individual or through a corporate structure, LLC, or some other partnership venture? And actually, does the taxpayer have a primary source of income outside of any of these crypto asset related activities? And are these crypto activities, in either case, are they performed or engaged in by the taxpayer on a full-time basis during the tax year? And do these crypto activities constitute or fall under the criteria to constitute self-employment? So on the one hand, the IRS has not been terribly clear on what constitutes a trade or business in this case. But on the other hand, there are questions that really we can ask, and I would say should ask, any clients who we think might fall under these expanded rules. And so A handful of other items here for any of you who have clients, be they individual or institutional players that are involved in more advanced aspects of blockchain or tokenized assets, be they DEXs, mixers, or they are actively mining or staking on their own. All of those are also areas that I would really encourage anybody who has clients in this space to follow up on and to try to get some more clarity as one on the nature, two, the scope, and three, any sort of dollar threshold estimates that the clients have. Okay. And so, okay, so if we have a client that falls under right these changes to IRS Code Section 6050I, what type of information has to be collected and then ultimately handed over? Basically, it's everything that is connected on that transaction. The name, the address number, the TIN, or the SSN, the amount, the date, and nature of these transactions all have to be collected, documented, and then reported out within 15 days, which I'll come back to that point in a moment. And if clients are in violation of these compliance requirements, there is a possibility that at some point those violations could turn into felonies at some point. But so right here is where sort of the ambiguity actually still is, right? Because who's all of this information being actually published to uh, and or shared with? Well, one, the IRS, and two, which is FinCEN. But actually, by its operating charter, FinCEN has no authority to collect crypto information. And so all of that information and all the extra Form 8300s that are going to have to be completed basically right now, and if not right now, uh, I'd say very soon, you know, how do I actually share it with these agencies who don't have the authority right now to collect and hold on to all of this information? So all of that has really caused, quite a bit of consternation right here. That if you have taxpayers that, as the rules are written, are going to have to follow these enhanced compliance requirements, and they aren't able to actually turn over this information to the appropriate agencies, we by default then have a problem. And on top of that, as this, or rather, as these changes are effective as of 12/31/23, and since all transactions have to be filed and then documented, filed, and then shared in 15 days, technically there is the risk of clients that had transactions in crypto going back to mid 2023, or rather mid December 2023, are going to have to be in compliance. But over the last couple of weeks, basically January 2024, there have been some more clarifying comments out of the IRS around the actual enforcement date of these changes and who has to comply, and then the Treasury issuing a new and updated guidance on these matters. But overall, right, these changes are already on the books. They have been put into effect. So now it's only a matter of time until the alterations are finalized, and then the full compliance is going to be, a obligation for us and our clients. There are multiple changes going on, both around taxes, as I'm sure most of you know, and there are a few changes happening to how crypto investors, traders, entrepreneurs are going to have to be reporting, collecting, and documenting their information, both on a transactional basis and on a income basis also. So in this code section, there's good news and there's bad news. The bad news is that, as we're going to see, the alterations and the obligations being put onto the crypto space are going to be quite onerous. But on the other hand, right, these are changes that all of us have time to actively prep for, because these changes to IRS Code Section 6045 only take effect for transactions happening after January 1st, 2025. And so the main online sort of debate and arguments on these changes really did tend to focus on who or whom or what qualifies as a broker for crypto asset purposes. But all of that, I think, is obviously a important issue. But but for our conversation here today, I'm going to focus on a few of the more tangible changes to this IRS code section that are going to have direct implications for pretty much anybody, be it an individual, institutional, or entrepreneurial individual who is buying, selling, trading, or even trying to use crypto assets. So off the top, these changes to Section 6045 are going to make compliance harder for crypto investors. Okay, because off the top, there are now two codified bases for how crypto investors can track their bases for tax reporting. First in, first out, or going through and IDing every specific unit as it comes in and out. Okay, that all sounds, straightforward stuff. But in the IRS reg, there is a note that the taxpayer must inform the broker-dealer of which unit is to be sold prior to the transaction itself happening. Okay, so that's extra, paperwork, extra obligation on the side of the taxpayers, aka our clients. But all of that does actually uncover a much bigger problem as far as how these changes are going to be implemented into the marketplace. So, as I was saying, right, to actually use or to not use first in, first out, which obviously, generally speaking, is going to create larger tax liabilities for most crypto investors outside of those who bought at the very, very top in April of 2021. So if the taxpayer, our clients, has to ID the individual unit prior to the transaction happening, that means that the broker dealers in crypto basically have to have those tools and that functionality or those options or that box to check, as most broker dealers in the TradFi space or in the equity space already do. And so, in a everyday example, for a client that is buying, selling, trading on Coinbase or on Kraken, right? That taxpayer has to notify either one of those broker dealers which units to move in and out of their wallets prior to the trade happening. Okay, and all of that probably strikes most of you as sort of just a sign of how the asset class is maturing and becoming more and more mainstream. But there's one huge problem sort of that hasn't really got talked about yet, that even the big centralized players like Coinbase and Kraken do not have the tools or other boxes to check or any other notification mechanisms to allow investors to actually do that. So it is operationally impossible to have our clients, taxpayers, notify their broker dealers to ID which unit is being traded at. It is, as of right now, operationally impossible. And so, in that case, if the broker dealer being used is not able or is not capable of offering that functionality, that means that on their end, right, on their 1099s, they're going to default to first in, first out. And so that is going to automatically create cases where the individual taxpayer hopefully has their own records, hopefully. But any records, even if their individual records are accurate, complete, and all supported, those records and any gains, losses, bases ID'd in those records are not going to match up to the 1099 information that is produced by the broker dealers like Coinbase or Kraken. And then don't forget, all of that information goes to our clients and out to the IRS automatically. So that's by default going to create a massive headache for anybody out there that has a client who actively trades crypto assets. Even that client, or rather, even if those clients use firms that are regulated and audited, and in the case of Coinbase, publicly traded. And so, just a heads up here that as a direct result of these mismatches and gaps between client records and broker-dealer records, that's going to create a case where taxpayers, aka us and our clients, are going to have to figure out what those differences are, right? Because having records not matching in any sense is going to be an issue. And more on the real sort of head of it, as we work through and we sort of go through and reconcile any differences, how do we communicate that to the IRS, right? Because don't forget, all of the information or the only information in the hands of the IRS is that 1099 data that is directly basically transmitted to them by the broker dealers. But as we outlined, those gain, loss, and cost basis information aren't going to be correct in the vast majority of cases for any traders or any crypto investors. And so, on top of that manual work up front on our end, there are also going to be questions afterwards. Now, it's probably not going to take the form of a full-blown IRS audit immediately for most investors in this space. But all of these are topics and items that I would encourage anybody who has any tax clients who are traders in crypto to really start, asking about and having in 2024 to try to get us collectively ready for these changes that take effect again on January 1st, 2025. And so for any of you here today who are not yet a member of the NJCPA Emerging Technologies Interest Group, I highly encourage you to all join. And all of that data can be found at njcpa.org/groups. And every episode of the IssuesWatch podcast, including this one, is at njcpa.org/podcast. And for more information related to crypto, blockchain, tokenized assets, all of that, podcasts, webinars, articles, all of that is available at njcpa.org/pub/crypto. Thanks. Have an awesome day.